Hello, I think we're starting. So yes, thank you everyone for joining today. Hello and welcome. This is the launch of OMFIF's Digital Asset Report 2023. My name is Lewis McClellan. I'm the editor of the report and of the DMI, and I'm delighted to have you all here today. I'm going to begin with just a quick summary of the context for this report and some of the key findings that we have. And then I'll bring in Daniel Iden, who's an advisor and solution architect at the Bank for International Settlements Innovation Hub, and we'll be discussing the use of DLT in traditional finance. And then I'll say goodbye and hand over to my colleague Phil Middleton, who will moderate a panel on the approach to crypto assets with representatives from Ripple, FATF, and NYU. Before I get started on that, I'd just like to thank our sponsors, Aquina, Stellar Development Foundation, and TPICAP. Thank you for your participation in the report and all the insights that we've benefited from throughout the process of putting it together. So very quickly then, I'm just going to share my screen. All right, hopefully you can see that. Okay. And run through the report findings very quickly. So the thesis basically of the digital assets report is that, with the launch of Bitcoin back in 2009, that was really the start of, in a sense, a new financial system that runs in parallel with the traditional one. It's much smaller, it's technically incomplete in some respects, there's scams absolutely rife throughout some of the worst parts of it, but nevertheless it's a financial ecosystem with its own service providers and its own market. And despite the fact that it was founded on principles that were explicitly hostile to traditional finance, the lines between these worlds are blurring now. It's tempting, excuse me, it's tempting because of the relative size of the two worlds to say that TradFi will subsume crypto and tame the sort of weirder eccentricities there and bring it into the fold of regulated securities and so forth. But that's missing the fact that DLT, distributed ledger technology, which is what underpins crypto, is being implemented across traditional finance. So it's not really a question of subsuming, but there's two simultaneous forces in play here, bringing these two worlds together. And that's what we're reflecting in this report. We've got two sides of it, one on sort of sanitizing the worst excesses of crypto and bringing in the rules and the standards and the infrastructure, perhaps most importantly, that we're used to in traditional finance into the crypto ecosystem to make it safe for regulated institutions to allocate more to. And then on the other side, we're looking at the ways in which DLT is starting to become used in traditional finance to improve operations and add new bits of functionality there. I'll just talk briefly about those two sides of the report. So on the side of sanitizing crypto, I think there were three key points that emerged. One, as I mentioned, the need for robust bank-grade infrastructure that gives institutions the confidence to engage with the market and the trust that they can do so on the terms that they're used to. One of the takeaways I think that struck me most in this report was that process has actually come forward a lot in the past couple of years, even while crypto asset prices have declined. There's a lot of progress been made there. Regulation, on the other hand, is probably the big limiting factor there. It's a global asset class. We need global convergence. We are getting national bodies kind of issuing their own responses, and that is helpful, but we need international bodies to kind of step in, and they are doing so, but we need a lot more progress there. And then finally on this side, the crypto winter had lent a lot of people in the official sector grounds for some understandable skepticism about the market. But as we go through in the report, there are some ways in which the asset class can still offer some very valuable innovation there, and we're exploring those in the report. And then on the other side, bringing DLT to the TradFi world, I think there's a lot of very interesting possibilities there. On one hand, looking at technology, again, it's really outstripped regulation. The ways in which DLT could technically change market structures are very exciting, but the limiting factor is still regulation. Although we are seeing things like the EU DLT pilot regime, which are giving us the chance to kind of explore what the possibilities are. Tokenization, real world financial assets, that's progressing very rapidly. There's healthy secondary market trading systems emerging there. And then finally, new digital primary market instruments, mostly blockchain bonds and things like that, are emerging. There's an impressive pipeline of development there. But it's important to acknowledge that these two worlds, the secondary and primary, are not yet really connected in the way that that they are in a sort of healthy financial ecosystem. So that's an area for development going forward. With that, I'm going to stop sharing, and yes, hopefully you can see me now. And I'll bring in Daniel Iden here. Daniel, it's great to have you. Thank you for joining us. I wondered, could we start off, can you tell me a little bit about what you feel like are the most promising consequences of applying DLT to financial infrastructure? What are you kind of hoping that this delivers?
That's a great opening question. And of course, Lewis, thanks for having me, and for OMFIF and the whole team. It's a pleasure to be here. So you're talking about kind of the progress with DLT, distributed ledger technologies. Broadly, I think my instinctual answer to that question is it really depends on how tightly correlated you think DLT is to tokenization at large. So DLT is potentially a platform that enables tokenization. And I think it's through this tokenization that we see a lot of the value adds to the actual industry. Now, what those value adds actually are depends a lot on the use cases and who the users are and what the context is. But in general, what we see through the process of tokenization is this ability to not just store assets, but store assets along with the rules and requirements of interfacing with them, and letting those things move across systems in a way that carries not just the asset value, but also the kind of rules of engagement. And when you think about that at scale, I think that of course, can reduce a lot of potentially unnecessary intermediation and enable the users of these systems to have a little bit more of a direct control and responsibility over these assets. So that's kind of the 10,000-foot view. So now different asset classes will have different types of arrangements with what we think about tokenization. I mean, you could tokenize purely financial assets, which may be easier than, for example, tokenizing physical assets. But different asset classes have different value when you think about tokenization. That value proposition is becoming clearer and clearer. I think here at the Innovation Hub of the BIS, we're doing a lot of work on tokenization, and that goes both on the payment side in the form of CBDC and tokenized deposits and things like that, and also on the asset side in various asset classes that we're looking at as well. The extent to which DLT supports tokenization is probably another conversation. You could claim that you could tokenize things potentially without a DLT, but in general, the architecture around distributed ledger technologies lends itself well to supporting tokenized infrastructure. So I think so far as that goes, I think there's good promise for seeing more and more of these distributed systems really come to life in a production context.
Yeah, you mentioned different types of assets that you can tokenize, and doing this report, it struck me that it's an oversimplification, but broadly kind of two philosophies about the types of assets that are best tokenized. And some people are looking to tokenize ETFs and things that are kind of already quite efficiently traded, but can be incrementally improved. And some people are looking at tokenizing illiquid assets that are, that aren't kind of efficiently traded at the moment. And there's much bigger improvements to be made there, but maybe tokenization isn't enough on its own to make those improvements. Can you talk a little bit about where you guys feel like you can contribute in the move to tokenization, and what you guys feel is a valuable asset class for tokenization?
Yeah, sure. So I think there's probably two good kind of two good approaches to this. One thing is kind of taking things that are existing and just making them more efficient through the process of tokenization. And maybe that efficiency gain actually leads to potentially different use cases, right? So a good example, we have a project called Project Genesis that we've run out of our Hong Kong center, and there we tokenize government green bonds. Now, you could say, well, government green bonds existed before tokenization, so what's the big deal? Well, the big deal is that the efficiency gains that we were able to produce by tokenizing these government green bonds gave us the ability to actually create much smaller denominations of them and offer them to retail investors. And actually, the Hong Kong Monetary Authority has taken Project Genesis and kind of ran with it in a production context and actually issued these type of tokenized green bonds to retail investors. So that's a case where, at a kind of superficial level, you can look at it and say, okay, this is no big deal. You're just making an existing process more efficient. But as a consequence of that efficiency, all of a sudden you're able to provide these really, really small denominations of tokenized bonds, something that before wouldn't be possible simply because of the overhead. So that's kind of on the retail side. You can kind of think about that as kind of democratizing access and things like that. I think the other side that I would highlight that has a high promise is actually kind of reducing risk. So it's not just about efficiency, it's about just taking risk out of the system. That could be credit risk or intermediary risk or settlement risk. But when we look at big denominations of, for example, government bonds in wholesale markets, then tokenizing a government bond so that it can be the delivery leg of a delivery versus payment, and creating that atomic settlement for the delivery leg and the payment leg, would all of a sudden reduce or potentially even eliminate a lot of the settlement risk associated with these type of transactions. And taking that risk out of the system, of course, nothing would happen on day one, but I think over the course of time, we would see less and less risk embedded in these type of systems. And I think overall that would lend to financial stability and monetary stability at large. So those are kind of the broadly speaking, kind of two categories that I would put a lot of the value add of tokenization into.
Yeah, I think that question of mitigating the counterparty risk is really interesting. It was something that when I used to cover bond markets, the bankers didn't really talk very much about, because it's not risk that sits with them. But then when you speak to venue operators, as we do in this report, that's where you find out these are people for whom bearing the risk of failed trades and counterparty risk is a serious investment in collateral and manpower as well. So we've talked a little bit about the promise there. Can you tell me a little bit about what the bottlenecks are? What are the challenges that are kind of still making it difficult for implementation of this to become a bit more widespread?
That's a great question. I don't know if I would call it bottlenecks. I think the industry kind of keeps oscillating back and forth between kind of like exponential innovation and then incremental innovation. And I think, everything's all great when we come up with these big ideas and these kind of big, huge changes. But at the end of the day, progress is incremental. And I think the challenge is creating a kind of an innovation roadmap that takes incremental steps, where every step of the way there's value and every step of the way leads to the next step of the way. So it's really just a question kind of prioritization and what to do first and how, just from kind of like an innovation strategy perspective. And that brings me to kind of like scoping. So the more scope you provide, I'll give an example. If you could have a ledger that you could put all the asset classes on, payments and delivery assets and all this stuff, that you'd get the most kind of bang for your buck, you get the most impact. But then the actual ability to take something like that into production, of course, is much, much harder. So creating a scope that's both impactful and provides value at every step of the way, I think is probably one of the biggest challenges. And when we think about this type of innovation, at its essence, when we start thinking about tokenization and movements of funds between different participants, you kind of inherently need to choose participants that are disconnected. So I would say a lot of the challenges are actually on the governance side, and maybe also correlating with that on the legal side. If there's different jurisdictions that are that get involved in multi-jurisdictional projects, I think that those functions seem to kind of lag one step behind. So it's not so much about saying, oh, the technology, we can show that if we deploy a distributed system and we tokenize these assets, we can do these settlements, and it's quick and it's easy and it's fast and it's transparent. I mean, a lot of that work has been done either by the private sector or is now being done through different proofs of concepts and pilots in the public sector. But then it's once that's understood, is creating the right legal context around it, creating the right governance context around it. And those things tend to be slower and often more challenging, because a lot of the tricky work lies in those elements. So if there's a slowing down function, I think that's it. But I don't see that necessarily as a negative. I think that, taking that kind of prudent, cautious approach, we're not trying to produce innovation that's going to last, 5 or 10 years. I think we're looking at potentially new arrangements that could last, 20 to 25 to 30 years. So I think we really need to think about these things carefully before we build something that, is great for the next 5 years, but is maybe redundant quicker than we would like. So I think that cautious approach is warranted.
Yeah, absolutely. I think it's been really interesting. I think there's been a lot of stuff that we've read about in this space that people talk about value, down the line when it reaches critical mass, when you get everything kind of onboarded into one system, but actually getting there, there isn't really a roadmap to getting there, because as you were saying, you need to kind of deliver value each incremental change, and that's quite a difficult thing for people to create. In terms of, I think one of the bits of feedback that we got when talking to people about this was that I think for a lot of a change in technology, regulators still need to be able to supervise markets in real time, and that's something that is a technical challenge as much as anything. And can you talk a little bit about how regulators are going to be able to discharge their obligations with a new kind of form factor for the technology?
Yeah, sure. I mean, regulation it's always kind of a cat and mouse game a little bit between supervision and regulation. I think one of the themes that we look at here at the Innovation Hub is regulation and supervisory technology in particular. We're very aware of the fact that as the tools change, how they are supervised and how regulators regulate needs to evolve along with them. There's of course a lot more data. Global markets are a lot more connected, and things get more and more challenging to harmonize and regulate. There's a few projects that we're running here at the Innovation Hub along those lines. I think probably the most mature of which is a project called Rio. And Rio is a project that we have built for regulators and supervisors to regulate foreign exchange markets. And it's essentially kind of a real-time data feeds from some of the biggest exchanges in the world with some of the biggest currencies in the world in real time, so that central banks can see real-time movements in the market, both at the breadth and the depth that they need to instantly. So this is a new type of function. Sorry, I shouldn't say it's a new type of function. It's a new tool for the functions that the central banks need to provide. And our hope is that this will kind of bring central banks up to speed with the pace of the markets today. If you think, just to ground this in reality, a lot of the regulatory and supervision structures now that exist for foreign exchange markets have really been devised in an era where the primary actors in these markets were brokers, calling each other on landlines, right? So it's like, if you fast forward to today, and we're talking about, algorithmic trading of trillions of dollars a day that are primarily driven by machine-to-machine trading. It's like, the central bank regulators can't pick up the phone and call the brokers, call the exchanges and say, hey, what's going on in the markets, right? They need something instant, quick, at scale. And it's not just about access to the data. It's also about being able to visualize the data and being able to distill insights from the data that are meaningful to policymakers, to potentially regulators that intervene in the markets, regulators that traders in the market. I mean, there's a whole swath of different roles at central banks that interact with these markets in different ways. And Rio is one potential platform to enable central banks relative to the speed of the market today. So yeah. I think that's a very, very important lens to have. So it's not just about moving innovation forward; it's also about moving innovation forward in a way that's responsible. Yeah. When we look, another good example, when we do our work around central bank digital currencies, and now we're looking a little bit more into tokenized deposits and stable coins and, the ecosystem at large. So very much public-private sector participation. One of the things that we look at is this notion of embedded compliance and embedded regulation, right? So we're really taking something that used to be, I don't want to say an afterthought, but you would have your primary function, and then the regulatory capacity would kind of be bolted on top. We're taking that function and saying, hold on, what would happen if we would put this in the system itself, either in the asset itself or in the system itself or in the transaction rules itself? All of a sudden, you get a lot more efficiency and potentially even new use cases that can come out of regulation and supervision, maybe not hindering the development of these tools.
Yeah, I was going to ask about how DLT might change the environment for that kind of tool, because people talk a lot about the transparency that it enables, and I can imagine in some ways that might actually be easier for supervisors. But I think, as you mentioned, maybe even more powerful than that is kind of embedding the rules for engagement, who can hold what within the assets themselves. That is also going to be a big factor. But yeah, I mean, on the transparency idea. Is that something, I mean, presumably Rio is kind of built to operate across DLT or centralized technology. How does that work for you guys?
Yeah, Rio can essentially pull data in from anywhere. So you could take a platform like Rio and pull data in from centralized exchanges, or you could potentially pull data in from different OTC functions, or you could take a function like Rio and actually kind of bolt it on to a platform. And that platform could be different types of multi-CBDC ledgers, or different type of domestic ledgers if you want to focus on domestic economies. But essentially the data source is left kind of modular with respect to the platform itself. Of course, different data sources would warrant different types of visualizations and different types of charts and different kind of different intervals of data flow. But the general goal is the same. It's to provide immediate information with accurate analysis capability on top of it, to bring regulators up to speed with how fast these markets are moving. And the volume of these markets is really, really important, right? So you can create a scenario where even if you have the data actually, you can't make sense of it. It's almost too much stuff coming at you all at the same time. So as the velocity of money goes up, as things become more interconnected, I think keeping a handle on the other side of things is really, really important.
Yeah, I think that's something that came up a couple of times in the report, that structuring the data such that it can be interpreted and manipulated effectively is probably a bigger factor than whether it's distributed or decentralized, or centralized rather. Just because you mentioned CBDCs there, we have a question from the audience here asking about in the BIS Innovation Hub Enbridge model, what DLT is utilized to serve as a neutral bridge for the various CBDCs?
It's an interesting question. So I'm not sure if that's a technology question or if that's kind of a governance question. When you say neutral bridge, there may be some assumptions in that question that may be slightly misleading. So the idea of the Enbridge ledger is that all of the central banks coordinate on the consensus function. So the central banks sit at the center of the ledger. They facilitate the consensus protocol. That's a distributed protocol between all the central banks. There's certain transparency and visibility requirements that were built into the ledger. Probably most importantly, that only central banks banks are involved in the transaction have visibility into the transaction. So for example, if a commercial bank from the UAE is paying a commercial bank in Thailand, then the corresponding central banks of those regions will be able to see the transaction. For all the other central banks in the system, that transaction would be visible to them that a transaction exists, but they wouldn't be able to see the details of the transaction, the counterparties or the amounts or anything like that. So this kind of consensus function that I think is connected to the wording around a neutral bridge is kind of, it's almost like an offshore settlement with respect to all the jurisdictions. So no jurisdiction has kind of control over that settlement function. So you could see that settlement function in an Enbridge-like architecture as offshore or potentially neutral with respect to all the counterparties. Now, the Enbridge project that I had the opportunity to lead for a little while when I was based out of Hong Kong was a pilot experiment. So to poise that question in a pilot where we can set up kind of the right regulatory structure for a specific time-bound interval with specific premeditated transactions, that's kind of, I don't want to say that that's easy, but that's one thing. Doing that in the real world, where, like I said, it lasts for the duration that it needs to last for, with the appropriate governance controls, with the appropriate legal arrangements, that's really a whole other category of work. And I think it's still to be determined if a model like this can go from, a pilot environment, which is very close to a testing lab, but, manipulating more real world like scenarios into, a production setting at large. I'm not saying it can, but I'm also not saying it can't. So I think it's still to be determined whether or not we can pull that over. And maybe to go back to your earlier question, I mean, it's not because of technology. The technology has shown that these functions are possible, and we can create this type of environment. The question just is, around governance, around the evolution of the platform, around different participant arrangements, around legal requirements that cut across different jurisdictions. I mean, all these things are very, very complicated to solve in the production setting.
Yeah, absolutely. Thank you for that. So running reasonably short of time here, so I wanted to go back to what I said at the beginning about this idea of kind of a blurring of the lines between the crypto world and the traditional financial world. Is that something that you're observing? I mean, do you feel like that's true? And insofar as it is true, do you feel like, I mean, we've maybe discussed a little bit with Project Rio, but what threats, if any, does that pose, and what kind of powers or tools or bits of infrastructure do the regulators need to kind of preserve financial stability as these kind of worlds merge? So I guess that's kind of two parts, right? Partly it's incorporating crypto, but also it's incorporating DLT into.
Yeah, it's a great question, and I'm not sure I'll be able to answer that in a way that's super enlightening. I think that when I look at the DeFi world, and I probably should have prefaced this conversation by saying that I speak only on my behalf and not on behalf of the organization, so these views are really only my own. But we look at the crypto world in the innovation lab, and we look at a lot of the technologies that underpin a lot of the crypto platforms, and we kind of evaluate which technologies kind of hold their weight and which ones maybe don't. I think when I think of the crypto world in general, the thing to me that is kind of the defining attribute of the crypto world is the fact that crypto assets kind of ultimately don't have an issuer, right? They're issued by protocols, they're issued by platforms. So I don't want to pay almost any attention to that part of the crypto world. In that sense, the crypto world and the fiat world get their authority from very different places, right? The fiat world comes from the trust that the central bank has within an economy, and the crypto world has an ethos that is very, very different. With that put aside, though, there's a lot of tools in the crypto world that, if you pull them into a more regulated fiat-like environment, have potentially huge consequences. And this is a very timely conversation. We just released a project called Project Mariana, and in that project, we took something called an automated market maker, which is, I want to say, an invention from the crypto world, and pulled it into the CBDC world and said, what if there are CBDCs in the future and we want to rethink how FX markets work? Can foreign exchange markets be now underpinned by automatic market makers instead of by centralized exchanges based on order books or over-the-counter exchanges that are based on different client relationships? And when you take a technology like that works in the crypto world and you put it into the regulated central bank world, well, first of all, you have to see if it works according to the functionality that central banks are looking for. And you can think about this like sometimes the crypto world is like roads in a town, and the wholesale markets are like the super highways. So it's not exactly clear that the vehicles that drive on this road will also be able to maintain pace on this road. And then you kind of have this a different function where in the crypto world, if things go bad, it's like, okay, we tried. Sometimes it works, sometimes it doesn't work. There's the recourse is very limited. Whereas you can't really carry that into definitely not the CBDC world, but let alone kind of the more regulated world as well. So I think we need to have a much more risk-averse, careful approach, because at the end of the day, these things have to work not just on the sunny days, but also on the rainy days. And if the crypto tools don't work on the rainy days, there's more tolerance for that type. So I think in some kind of way, these worlds are a little bit symbiotic in that, a lot of things can get tested in the crypto world and they can provide value, and there's no problem with that as long as the risk is contained. And of course, as we know, sometimes that risk manifests itself in ways that aren't so desirable, but it is what it is. That's the price that you pay for, racing ahead. And I think what we try to do here at the Innovation Hub and at the BIS is look at that world, understand it, evaluate it in its own right. And when we see tools that we think are promising, test them out in our context. And when they show promise in our context, try to evolve them to a place of maturity that can potentially go to production. So, hey, maybe we will live in a world of CBDCs and tokenized deposits, and all of our exchanges between different types of currency will happen on AMMs. Maybe we won't, but that's definitely something that we want to be empowered to understand and decide as we go forward.
Yeah, absolutely. And I think that's very much in line with what we're trying to do in this digital assets report as well. I think there's, as you say, a lot of really exciting innovation coming out of the crypto world, and some of it does seem like it could change the way things are done in traditional finance for the better. And there's a need to kind of disseminate that knowledge and have it tested by people who understand the limitations and the requirements that people in traditional finance are operating under. Thank you very much, Daniel. This has been fascinating, and yeah, great to have you. And I hope we'll hear more from you in the future. And certainly we'll be keeping an eye on Project Rio, Project Mariana, all the rest of the work that you guys are conducting over there. So thanks a lot. With that, I think I'm going to hand over to my colleague, Phil Middleton. So don't go anywhere, but we will speak to you in just a couple of minutes. Thank you.
I better have this set of glasses on. There. Right. Now, am I too close there? Right, the studio seems to be informing me that we are back in full swing. So welcome back. Glad you enjoyed the break. I'm joined by three really outstanding interlocutors now for a debate about some of the issues arising from the report and many other things. So I'm delighted to welcome, in strictly alphabetical order, Professor Richard Berner from New York Stern School of Business at New York University, and he's a man who has seen all sides of this debate, both as an investment banker, a financier, a central banker, and now a leading academic. So he's going to bring some good perspectives. We then have a frontline combatant here in Tom Nayland, who is with FATF, Financial Action Task Force, leading a lot of the work on counteracting money laundering and financial terrorism, etc., and responsible as well for many of the aspects of the Moneyval program. And third, Anthony Ralphs, who is the Director of Product Management at Ripple, and a man with 25 years of detailed experience in both technology and payments, subjects upon which he is deeply passionate. So start off, two or three big conclusions coming out of this research, which we did over 6-month period with a lot of participants from industry, from central banks, from regulators, from academics, to try and get a sense of where the digital universe is heading in the aftermath of the crypto winter, so to speak. And there's one view that says actually an awful lot of the froth, the hype, the growth has moved away. Digital assets have come plummeting to the ground. CBDC is all on hold, and the real interest has moved off to AI and various other things. And what we're seeing is that instead of a technology and a set of instruments that were going to change the financial world irrevocably and in very revolutionary ways, what we're seeing actually is some very useful technology that is going to improve the plumbing and infrastructure of financial services, but without bringing about radical change. Secondly, that we therefore are starting to see a big convergence between what we may call crypto or digital technology and what I think we now are calling TradFi, although in some quarters I gather it's being called real world assets. But for me, RWAs are always risk-weighted assets, so I'm going to stick with TradFi or fiat assets. And largely because exchanges, regulators, and indeed market participants don't really want to be maintaining two parallel systems. They want to have a convergence and a one-size-fits-all. So we're going to see that. And finally, that it's increasingly obvious that however this market develops, it is very dependent upon a dialogue or otherwise between regulators and the industry. And we have a spectrum there of regulators who really see themselves as sheriffs and enforcers, and regulators who'd like to be considered as partners and participants. Interesting to explore some of all that. So having set that ground, I'm now going to retire and start firstly by asking Professor Berner to give us his reactions to that, and hopefully he thinks what I've been saying is completely contentious and is going to disagree violently with me. So over to you, Richard.
Okay, well, not shirking controversy. Thanks very much, Philip, for having me and on this great panel and in this great setting. And I want to say, first of all, that I'm glad that you've put out this report, because I think it does make, in many respects, the useful distinction between the asset classes that are called bundled under the crypto umbrella on one hand, and the technology that is used and innovation that is used in financial services that I think can have great potential and great value. So the question is, do your conclusions hold water? Well, I think some of them do. Certainly the technology developments people are using to advance are the efficiency and to some extent reduce the risk in financial services. And we heard some of that on the previous panel from Daniel Iden from the BIS Innovation Hub. And the experiments they're running, the pilots that they're running, the way they're using what might be called sandboxes that allow people to experiment, those are all valuable in technology. And of course, technology is not new to financial services. It's as old almost as I am. And ever since the development of new technologies, financial services providers and their overseers have been using technology to improve speed, to reduce cost, and to manage risk. So those are all good things, and further development is obviously welcome there. I think that the point about crypto assets, though, and whether that's converging with TradFi is a very different story. Because I think when we think about what builds trust in financial activities and what builds trust in financial assets, that's really at the heart of, I think, the difference between the two things. Now, in the financial crisis, obviously, we lost some of that trust. People lost trust in our authorities and our institutions. And I think that's still manifest today to some extent. But we have to ask ourselves, so what are the key elements to build trust? And Daniel, in his presentation, alluded several times to the use of the word governance. And that's where I would start, because I think that the governance in the crypto world is quite different from, but doesn't have to always be different from, that in the traditional finance. Governance in traditional finance is not perfect by any means, but it's been based largely on solutions to collective action problems. And in a brief that I wrote with two colleagues at Bretton Woods, we talked about an overarching principle, which is if we have a governance issue in traditional finance and in digital finance, and there may be some convergence there, the same issue ought to result in the same or be solved by the same governance outcome. So we have 4 ways to strengthen governance and the underpinnings for trust in the crypto ecosystem, which the industry, I think, needs to adopt. First is to develop and adopt shared codes of conduct and best practices for coders, money services businesses, and exchanges. Second, I think we need to implement high expectations for transparency. I got to stop right there because, in some respects, the crypto world doesn't consider transparency to be its friend. So the question really arises how to achieve that and balance the other potential benefits that crypto might offer. There's a third thing, which you alluded to in your remarks, which is we think that we need to promote constructive exchange between the crypto industry and regulators and their overseers, their supervisors. That certainly does not mean that we want to see them captured. You kind of alluded to that in the way that you framed your conversation. Nor does it mean they're always adversarial in their relationships. The constructive exchange means working together to understand the technology, working together to achieve shared goals, to manage risk, particularly those which lie outside the 4 walls of any business, including, for example, financial crime, which Tom's going to talk about, including financial stability, which I've spent a lot of time thinking and working on, and all those things that are larger constructs in our financial system. And then, of course, the last piece that we recommend is to coordinate globally, because markets and institutions are global. A lot of the risks that we're talking about that need to be managed in order to build trust have a global dimension. So we need some, if not the same regulations, because there are different laws, different jurisdictions, obviously, but we need to have the same principles that undergird these things. So this is this, I commend this to you, and I think that it's complementary to another brief that we wrote on crypto regulation, but I'll leave that for further discussion.
Sorry, there's some difficulty with my mute button. Thank you for that, Richard. I'd point out, ladies and gentlemen, that a couple of the papers that Richard mentioned will be available for download from this particular site as we go along. So please take advantage of those along with the digital assets report. One thing perhaps I could ask you, Richard, the whole premise of the crypto digital asset world seemed originally to be based around bypassing, if not destroying, the whole of traditional financial services and creating something that was completely different and that was neither regulated nor transparent nor in any way subject to official interference. And now we're saying, well, actually these two worlds might converge. Can you really do that without one or the other having to compromise quite massively?
Well, I think the point is that we can have different technologies that serve different purposes. But when we look at a particular function and activity, if you will, in financial services, then, we ought to have, as Augustine Carstens and many people embrace, we ought to have the same, if there's a risk involved, then the same risk ought to be met by the same regulatory outcome. Not necessarily the same regulatory tools, because, they may differ both across jurisdictions, they may differ for different asset classes and so on. I think that if we adopt that premise, and if the crypto world were to embrace that, the kind of convergence that you're talking about might happen. One of the great ironies of the crypto space for me is that while they talk a lot about decentralization, the fact of the matter is that a lot of activities in crypto have become increasingly centralized. So the question is, why is that happening? And I think it's happening because people perceive that in order to improve functionality, indeed to perhaps have any functionality at all, there has to be some centralization, some agreement on rules of the road, as I just mentioned. And some of those things get embedded in the technology. So I'm all for thinking about, for example, if I'm a supervisor or a regulator, using technical tools referred to as RegTech to make my job easier so I can, understand and digest and curate lots of information, which is mentioned before is just coming at us through the fire hose, obviously, and how we curate that, how we analyze that, how we use that to manage risk. That's really at the essence here. If you lack transparency and you really don't know what's going on here, and you're worried about counterparty risk, which is not eliminated through these new technologies, then you have to think about, well, how am I going to manage that? How am I going to understand it? And that's where the paradox, if you will, or the conundrum of having this convergence occur really lies.
And I'm on record elsewhere as having written that I think there's some very, very good reasons why major financial exchanges have existed for 300 or 400 years. And it's got a lot to do with what you mentioned earlier, which is trust and liquidity and scale and common codes of practice.
And one of the things that, as I think about the functions of the financial system, one of them obviously is price discovery, where people come together, buyers and sellers come together and agree on the terms and conditions and the unit of account that they're going to use to make those exchanges, and then use the infrastructure in our financial system to settle and clear and pay for that transaction. All those things often, they don't need to use the same tools that we're using today, far from it, but they need to perform those basic functions in an atmosphere of trust.
Thank you. Let me pass to Tom, who it's a natural segue. Richard talked a lot about the need for shared codes of conduct and rules for same risk, same regulatory outcomes. And Tom, you're in the front line of trying to do that. How difficult is it, and how close are you to where you'd like to be?
And that's very much the day job. What the FATF is all about as a standard setting body is trying to frame rules in a way that can be implemented in any number of different national legal systems or administrative systems, something that is neutral about whether you're common law, civil law, Islamic law, various other legal traditions, but where it's as much as possible compatible across different borders, so that a borderless business can carry on in a frictionless way. That's not easy to do, and it means oftentimes stepping back and not regulating things in great detail, but putting them at the level that you talked about. Same risks, same regulatory outcomes, more or less the same rules, but what we found in the case of the crypto sector is those rules have to be thought of and applied in a very different way. And that's where the big challenge has been for regulators and supervisors as well. They've got to understand the new risks, and the new sector poses a very different sort of risk environment to traditional finance. But we've got the principle that's very well established that we have a risk-based approach. We don't want to put in place rules that are irrelevant or unnecessary and just get in the way, but we do need to put controls in place where they're needed. And if you take a very long-term perspective on the financial sector, then every meaningful regulation has got a bank failure or a crisis behind it, and each one of those is a stable door that a horse has bolted from. What we're hoping to do is maybe cover some of those issues before the crypto sector has all of these failures, rather than let it evolve over a couple of centuries like the banking regulations have done. So some of this is just learning from other people's experience and not making the same mistakes twice. Anyway, understanding the risks is a starting point. Building the capacity to actually supervise, to put in place rules that reflect those risks and the new technologies is a huge challenge, but supervisors need people who understand the new sector. They need tools. And most importantly, like Richard said, they need to build partnerships, because supervisors are never capable of imposing the rules in every case if there's a sector that doesn't internalize them to at least some extent and make an earnest effort to comply and have a culture of compliance. You can correct failures and mistakes. What you can't do is dictate everybody's actions at every point in their working day. So building those partnerships, building a shared understanding of where the risks are and what the rules mean, and getting the sector itself on board is, I think, one of the biggest challenges we have. As you say, it starts from a very anti-regulation mindset, but I think as the sector matures, people are starting to recognize where maybe some of those rules are necessary. One of the biggest pieces of discussions that I've had has been looking at who are the victims of hacks, who are the people from whom crypto assets are being stolen. And in most cases, they're being stolen from the exchanges themselves, laundered through other exchanges, and often that laundering is there to subsidize the North Korean weapons program, for example. That's the most egregious case. So when we put in place money laundering regulations in a crypto exchange, we're actually protecting it and other exchanges from an ecosystem of hackers who are targeting exactly them. And I think people are starting to realize the regulations are there to protect them and their customers, rather than just an imposition from governments that's not serving any purpose. But nevertheless, when we write those regulations, we've got to apply them in a very different way. The crypto sector might have some of the same risks, but they're distributed differently. And it also works on fundamentally different channels. So when we talk about payment transparency, the traditional financial sector has the travel rule, which requires originator information to accompany a payment. We're trying to apply the same principle to the crypto sector, but it doesn't have the same sort of walled garden approach. It doesn't have its own payment communication network. So we have to apply it in a very different way. And the global regulatory community has spent 5 years working with the industry to try and nurture the development of protocols that are going to enable that principle to be applied without compromising privacy, without compromising the speed of execution that the crypto sector depends on. There's another issue which we're still grappling with at a more philosophical level, which is maybe what Richard was talking about on governance. We're used as supervisors to dealing with governance in a traditional institution, which has a board and a senior risk officer who is accountable for the measures that have been taken. What we're seeing now are decentralized protocols where some of that is automated or even all of it is automated. And supervisors are having to think about, how do you supervise a blended governance model where some of those functions are replaced by algorithms and others are human beings? So they're difficult questions. They're not quick to answer. But we've had, I think, 5 years since the FATF wrote global rules on how to combat money laundering in the crypto sector. Now, supervision usually moves at a pretty glacial pace, but in this case, we've moved very fast. We're still struggling to catch up with the fact that a lot of jurisdictions are still waiting to regulate and legislate for this. It's not an easy job to stand up a new supervisory authority and to pass primary legislation to deal with a sector such as this. So 30% of countries have managed it. That's great, but it means that 70% haven't. And what we're trying to do at the moment is focus on the most mature markets, the biggest user bases in that 70%, and bring them up to the point where they've got the basics of regulation in place as quickly as we can. This is a real concern for us, for the G20 ministers. We can't leave the global crypto sector as an unregulated space with safe havens that can be abused by money launderers, criminals, terrorist financiers, etc. So the big priority is catching up with the regulatory gaps at the moment. But one of the reasons we're so focused on that is because having a law, having an authority is just the first step. Building a relationship with the sector in your country, building an understanding of the risks, building a culture of compliance, and getting used to day-to-day supervision is a much longer-term issue that people are going to have to deal with afterwards. So perhaps I'll stop there. The last reflection, though, is the FATF is coming first, but there are lots of other standard-setting bodies and lots of other flavors of supervisor right behind us. So we move because the threat to life of money laundering and terrorist financing and proliferation financing is very urgent, but we have IOSCO on the securities side, which is working very fast now on measures around preventing market abuse, ensuring market integrity, custody of assets, and so on. We have the Financial Stability Board, which is working on how to ensure we avoid contagion between crypto firms and between the crypto sector and the traditional sector. That's the sort of convergence we really don't want. If a crypto collapse brings down a traditional financial institution, then we're really in bigger trouble. And we've even got tax bodies like the OECD's Center for Tax Policy. So all of those are working quite rapidly in this space. And I think a lot of that work, now that the hype has gone out of it after the crypto winter, that work is still going on, but it's maybe under the surface and less visible, but possibly building deeper foundations for a sort of stable and sustainable market in the future.
Sorry, thank you, Tom. There's a question from the audience. I can't really move on without putting it to you, which is, given that regulatory divergence between nation states and others seems to be growing rather than decreasing, given that regulators themselves are of varying qualities and varying capabilities and have varying missions, shouldn't we actually just let the industry self-regulate? Why pour all this resource into the efforts that you've talked about?
Oh, self-regulation is a difficult one. I think, and this is a personal view, that the industry isn't capable of self-regulating for the sorts of risks that we're dealing with, because as Richard said, it has collective action problems. It also has information problems. In order to mitigate some of the risks that we're talking about, it needs guidance and information from governments. It needs places like financial intelligence units, which can bring together information from all the different exchanges in a country and identify patterns of activity, patterns of flows that indicate something bad is going on that aren't going to be visible to any one of the market participants. And the market participants need a mechanism to ensure that when they take on a cost or avoid an activity, that their competitors and counterparts are also forced to do the same thing so that nobody's suffering a competitive disadvantage. And that's just regulation 101 in any sector. Avoiding divergences is where the standard setters come in. What we've seen in the crypto sector is that a few countries, which were the first to develop these technologies, didn't have the option of waiting for us. So they have built national supervision regimes based on their existing structures, and those were in place long before the FATF wrote our standards. So US firms have been regulated for a few years longer than the FATF standards have existed, but it's those countries that help shape and form an international consensus and rules that can be applied universally, and then adjust their own systems to come into line with them. So the FATF standards, the IOSCO standards, the FSB's principles are the sort of rules that all of the global standards are going to converge on. But there are some areas where people differ for very sound reasons. There are, for example, differences between the type of information that national authorities require. Just because of different cultures and different ways of living your life, I mean, different pieces of information are relevant, for example, as a unique identifier. Some countries use a national ID number, some countries don't have that and think that it's a terrible imposition. We have different data protection and privacy rules. And this is one where even when the anti-money laundering rules are the same, they require you to share information, but sharing information might be under different data rules in the EU, the US, or other countries. And one of the big ones is we have different sanctions lists. So the targeted financial sanctions that you've got to comply with if you are in the US under OFAC are a different list to the ones that you have if you're in the EU or if you're in China. And that's one where people have got to do different screening processes, or at least screen against different lists in different jurisdictions. But everybody converges on how you do screening and the fact that you need to do it. So we're going to have a mix, but we're trying to make this as harmonized as we can without completely overshooting sovereignty.
Thank you.
Philip, could I just add to that?
Yes, and I was just going to lob in towards you before I bring in to Anthony, who's waiting there very patiently.
Very patiently.
Clearly, given the size of the market in the US, given the primacy of the US dollar, given the nature of American participation in the global financial markets, isn't it crucial that we get the regulatory standards sorted out in the United States? And when do you think that's going to happen?
Well, I can't predict that, but in answer to your question, I think the answer is yes, we need to sort that. But I think, there are lots of proposals in the United States. Some have emerged in the form of legislative proposals to have laws that enable regulation. There are other proposals that are being floated that touch on what you and Tom referred to, namely self-regulation with an SRO. For example, Tim Massad and Howell Jackson have proposed such a thing. My problem is I think that seems like a final step towards the goal that we want to achieve, but regulation without legal authority. And I think that if you're a regulator and having worked in that space for a while, you just have to have the legal authority to do things. Otherwise, you're going to be taken to court. So I think the role of self-regulation is important, but it's really to articulate best practices and good behavior, as I was alluding to before, in terms of governance. So that's why I think in the context that I framed some of these issues, the sequencing is important. Industry governance really needs to come first and then regulation. So the question for US participants is really, are they willing to articulate those best practices collectively as an industry, and then can they get together and propose sensible regulation that really address the concerns that we all have that are rooted in the goals of regulation to protect investors, consumers, to make sure that markets are fair and effective, to safeguard financial stability and prevent financial crime. I mean, if we can aim our regulation at achieving those goals, then I think we have a good chance of success. But what I've seen in the United States that has been embodied so far in regulatory proposals from our Congress hasn't met those standards.
Thank you, Richard. Anthony, you've been waiting very patiently, for which many, many thanks. We've heard the reactions from Richard and Tom to the report and to some of the issues raised. So you're very much in the front line here of senior participant in one of the major players in the whole crypto ecosystem. So if anybody is capable of saying, you know, are we going to get some industry governance and collective approaches to it, or is everybody still going to be doing their own thing? But over to you, really.
Great, thank you, and I appreciate the time on this panel. It's super interesting, and it was really interesting to read the report and look at that. I think that there was 2 or 3 bits that kind of highlight from previous panelists, but also some of the report. One of those is trust. One of the reasons why crypto came about was lack of trust. And so part of any ecosystem, you have to have some sort of trust authority or trust framework that ensures reliability and ensures access and usage. I think one of the points you highlighted in the report was, I think it was Argentina and Turkey had very high proportions of the population who hold crypto. Part of that, when you speak to the population, is it's trust in the government, it's trust in the authorities. So it's not just a technical problem here. There's a sort of societal problem here in terms of trust. So when Ripple approach sort of any of these projects, and I think this is kind of we're going to look at, I look at the sort of the way, I think, Tom, you mentioned about the hype cycle. I completely agree. I can think back to 2015, 2016, looking at all these wonderful projects that you could do. And it was very much felt like the sort of late 90s, early 2000s with the .com. There's all this stuff, all this hype, all the broth coming out. And it was only the sort of the real use cases or the actual meaningful usages really came on the back of that once that hype had died down. I think we're seeing that. And what we've always been doing is we never approach this space from destroying the incumbents. We actually want to work with the incumbents because we see that's critical to making this work. So even by the sort of the design of the ledger that we use, the XRP ledger, and we use a derivative of it for central bank digital currencies, it was always designed in a framework of how do we protect the governance of the ecosystem? How do we make it fast, efficient, affordable, and accessible, and designed for particular purposes? So we have a framework within our application and the way we work that you can define your governance model, you can define your trust model, you can define how change is applied. So if you look at these all in isolation, these are problems for any system. And it's about applying the rigor and robust systems management to any technology. And we think we can see this throughout the innovation of financial instruments over the decades, centuries, from the quality of the physical note, checks, how they're processed, etc. So we kind of take this, we understand the technology really, really, really well. And what we do is we work with regulators, we work with central banks, we work with authorities to sort of, first of all, educate them on how the technology actually works, tell them how it can be leveraged to really innovate in the space that they're currently operating in, either by replacing something or complementing something or putting something net new in that gives them a framework and a platform for innovation. But at the same time, we also work with the guidelines of that's currently there. And so I take RippleNet as an example, our cross-border payments network. One of the first things we did with the members of RippleNet was actually work out and say, there's a lot of friction here of moving value from one country to another. How do we help reduce that friction? How do we reduce that cost? And that cost comes from a multitude of different areas. Settlement risk is one that was called out, I think, in the questions. And yes, a bridge asset like XRP can help reduce settlement risk and reduce some of the cost. But it's the operational cost, it's the operational friction, it's the compliance. And so what we did was work with our members. We defined a rule book that all participants of the network signed up to that created a framework for what was a finality of settlement when you settle between two parties on the ledger. We also created a standard that preceded really the G20 and FSB work on looking at harmonizing the data sets for cross-border payments, because we were seeing all of our parties all had differing regulation. They all had, I think, Tom, to your point, they all had an application of it. But when you try to do a cross-border payment, as an example, they all wanted slightly different information. And then that was then counter to, well, one country doesn't collect that information versus one needs it. And so what we did was we worked with our members who are all regulated and defined some standards, defined some principles of how data should be exchanged, the format, the structure, and also how do you extend that in the need where you've got a jurisdiction that requires extensions. So every step of the way, we've always worked with regulators, because that's kind of, I won't say the gatekeepers to implementation of technology, but you kind of need to have regulation aligned to work with it. And it might be regulation is perfectly fine today, or it might be how do we identify areas where we can enhance the regulation or adjust the regulation to accommodate this new method. And when we look at this technology, we're not looking at this as it just wipes away everything. It's evolving what we've already done. And again, I kind of look back to the evolution of how people pay in the last 30 or 40 years, from people getting a paycheck or getting cash in their pay slips each week to being paid by BACS or an ACH service. And now we're seeing innovations there. This is the way I look at the technology. It's an innovation of that, but you've got to think about it in the context of how it works, but also the safeguards and the rules in place. Because if we don't do this, any industry is sort of susceptible to making mistakes and being compromised. And I think you see this, we can all think of various things in the last 20, 30 years where self-regulation to a point has had a problem and it's caused a problem. What we're trying to do is we actually promote and work out and create a safe framework that allow the actors in that ecosystem to operate. And I think about this everything from the central bank and the issuer of the money, all the way down to somebody, a sort of a 70-year-old who's opening and holding their crypto wallet. What happens if they lose their keys? It's all these kind of regulations, all these frameworks, these safeguards need to be put in place, because it's money at the end of the day. And it often has the most impact to the people that actually can't afford it. That's typically where it is. And so what we're trying to do is work out frameworks and work with regulators to try and improve that. So we see the next evolution of this, and I'm kind of giving you a very broad brushstroke of how we sort of see things. We see this next innovation of creating this fundamental infrastructure, these platforms that enable new use cases to be built on top of. So when we talk about real world assets, or essentially converting traditional mechanisms and applying them to DLT-based solutions, it's how do we help that innovation? And most of it requires a connection of multiple things, maybe a settlement token, maybe an asset token that defines the asset, that has the rules of the road around it. So you can't do one without thinking about it in its whole. And so that's at the heart of everything we're doing here, is to work with regulators. And just to point on the conversation about the divergence, I think we actually see a kind of counter. We see a lot of convergence around defining some common principles and actually setting some boundaries and some guidelines for participants to leverage the technology and to build new business lines. I think there's one or two outlier countries that are still struggling to sort of cohesively form an opinion on it.
Yes, we haven't heard much recently from North Korea. A couple of things emerged there. One is that this is actually going to be a very long run development. We need to be looking at decades rather than weeks and months. And secondly, the future is really not going to be about bored apes everywhere. Where do you see, Anthony, the real major developments coming? And since we've been talking about regulation governance, what are the major regulatory either obstacles or absences to those developments happening?
I'm possibly not the best person to comment on reggae. I'll try to give a sort of broad view of it, but certainly not my field of expertise. I think where we're seeing this happen and these projects take off really is the sort of the economies that have perhaps underinvested over the decades in technology, might not have much in way of infrastructure, or actually who are looking to leapfrog. They might have something that is really not fit for purpose anymore. And so rather than replace in a very traditional, let's call it Western world scenario, are looking at alternatives. And again, I think there's a lot of parallels to innovation with the likes of Africa. I prior to getting into payments and banking, I worked in telecommunications. We weren't putting cables in the ground in Africa, we were putting mobile masts in. That in itself promoted a level of innovation and a lower cost way of rolling out services. A lot of the countries we talk to, that's their mindset. It's how do we create this platform for innovation and development and potentially exporting expertise and building economies on top of this, because they can see where the technology is going and the opportunity. So I think there's that. I agree with you, the timelines, some are going to be protracted. I agree, it's definitely not weeks and months, but actually I think it's small numbers of years of these. I think this is a change management process a lot of the time. You need to manage the risk, you need to control that and make sure that when you're testing stuff, and Daniel also mentioned about this, the happy path, everything that we're looking for is the unhappy path. What happens when something fails? If I send you money, does it reach you? If it doesn't, there's a problem. So how do I roll back that or mitigate that risk so that the money, there's always a terminal state for that money to either you receive it or I still have it in my pocket. And so part of that is working through. So we actually expect maybe in 2 or 3 years for smaller economies, emerging economies, but in the more developed economies, that could be a decade or so. I mean, you look at the RTGS sort of improvements that the Bank of England are doing. I think that started in 2016, 2017, and still going. So some of these programs are very long, and that's kind of that balance that we're trying to achieve here of how do we solve some small problems that allow opportunity to be realized whilst not committing fully, and then allowing that to be gradually phased into a wider societal deployment or infrastructure deployment within a country.
And where do you think that the biggest societal benefits are going to come from? Is this in payments, particularly cross-border payments and remittances? Is it in wealth management? Is it in bond issuance? Is it in the operations of the capital markets? To name just some of the opportunities that the report talks about. Where do you think we're going to derive most benefit from?
Good question. Again, I cite back to the sort of late 90s. We didn't know what the internet would do for us then. We kind of had an idea. I think if I look at it first and foremost, the XRP ledger and the CBDC ledger was designed first and foremost to be a payments rail, essentially. Yeah. And so that's kind of what we were designed for. But everything typically results in a transfer of value or a payment in order to complete a transaction. So we see that first point of just potentially complementing existing systems. What we're also starting to see, though, is new streams of work, that projects that we're getting involved with. So we're involved in a project with the HKMA, looking at tokenizing real estate and releasing equity in the form of a digital token or digital currency. So you start to see these experiments come out that actually will start to reduce friction, reduce cost, and provide more certainty. That's where we're sort of looking at that. These are a multi-year project. I don't think ultimately we're building for my generation. We're building for the next generation with a lot of this technology. And so some of this will just take time to realize and to grow. And there's not going to be a one-size-fits-all solution. There's going to be a hybrid. So there needs to be interoperability. There needs to be consistency and joined up thinking around this. So again, calls for standards and governance and global cooperation is also critical here. Otherwise we end up with walled gardens. I don't know any more than that at this stage, other than we're talking to a whole host of different industry participants who are all looking at how could tokenization and this underlying technology benefit their industry.
And how, as a real technology specialist, to what extent do you believe the technology is now proven and scalable on a global basis, or to what extent are we still in the experimental phase that Danielle was talking about the need to take very, very small steps.
Again, I look at this as good at two things. From a technology perspective, the technology that we're using has been in circulation and been active for 10 plus years, with billions of dollars of value transferred in there, with minimal disruption or noticeable impact to the usage, with no loss of value. So I look at that and sort of say, there's no better proving ground than actually having something in the wild. Now, that's on one scale. And I think we touched on this about, Daniel also touched about this on the sort of freeways versus town roads analogy. Part of what we then do with any project is to ensure that it will scale to meet the needs of the project and the solution. It's about choosing the technology appropriately for the problem you're trying to solve for. It's a bit like, if you want to go to the shops, do you buy a Ferrari or do you buy a station wagon or an SUV because you can put all the week shopping in, or are you reliant on putting one bag in there? So it's about choosing the appropriate tool for the job. And then it's a case of managing that change, testing, rolling out, and doing that scaled process. That's how we approach all of our projects here at Ripple. So the most recent one you might have seen in the press with Palau, we did a limited pilot to basically prove that people could go and use it to pay for goods and services in restaurants and stores in and around Palau. Not just from a, could I spend the money, but what happens if I go to one of the islands in the state, in the nation, and do I still get the same service? So it's all these sort of fringe edge cases that you need to account for to provide certainty. And that comes back to the point of trust. If people don't trust it, they won't use it. So we have to take this very slowly, but grow and evolve this. And that's our approach.
I always stand amazed at the vast number of pilots that are taking place in beautiful island economies. They never seem to be in industrial cities. The question coming up, we do talk in the report a bit about stable coins and CBDCs and so forth. And I just wanted to get the panel's view on stable coins in particular. Are we ever going to see private stable coins as a primary means of exchange, and is that desirable? I know, Richard, you've got some views here.
Sure. So, one principle to start with is, unless they're backed one for one by very low risk assets, like central bank reserves or short dated sovereign debt or something which enables you to appropriately over collateralize stable coins, I don't think they'll be completely stable. And the chance of a run, just as with money funds, which they look like in some cases, will be unacceptably high. That doesn't mean our runnable liabilities in the financial system will disappear. We have others, and the question is how we manage those risks. So, there's several flavors of stable coins, just like there are other runnable assets. If they're explicitly backed, we should require a few things. One, the nature, level, and composition of the assets backing the targeted redemption value. Two, whether or not there's full or partial backing, that needs to be disclosed. And three, whether there's a backstop or contingent support. And I think those are important things to talk about. Those are all things that we've used in TradFi, really to identify similar kinds of assets and liabilities. So, there has to be disclosure, there has to be reporting standards that are proportional to the quality or risk of the stablecoins backing. Transparency is important here. We can't just say, trust me, and walk away from it. And really, fundamentally, Philip, I guess I would say to start with, what benefits do stablecoins bring to the table that we don't already have in some other kinds of assets? And there may be speed, there may be, risk reduction. I guess that all has to be proved. That's what, to Anthony's point and Tom's point, is going to build trust in these these instruments.
It may be in terms of access, people without access to the conventional financial system. It may be lack of trust in the conventional banking system.
Right. Financial inclusion is another goal that we, ought to think about embracing. And the question is whether these instruments will achieve that.
And Tom, how do you regard stable coins? Is it just something that needs to fit within the overall tapestry, or would you require a separate regime for them? How do you deal with them?
I mean, we've got quite a modest role as an anti-money laundering standard setter. We're not there to pick winning technologies or dictate the path that the industry takes, but whatever is going to be used to transfer value needs to be protected to the right extent against criminal abuse. That's it. So it's not our job to promote stablecoins, but every proposal that comes up, every technology that gets begun or developed, we have a dialogue with them to make sure that they're building their systems in a way that's compatible with protecting the integrity and identifying criminal activity. It's maybe a wider reflection, though, is there's a very cultural focus on technology across the sector. And people see getting the technology right as the biggest challenge, but getting the economics right has proved to be a bigger challenge and one that people have neglected and failed as a result of.
But actually, you mentioned M-Pesa, or the advent of telecoms related payment systems in Africa, 30 years ago. I can remember being involved in that. Let's assume that a big technology company, telecommunications company, decides to launch a stablecoin. Well, is that desirable, or what issues does it raise?
I think that there's sort of two things. I think it's kind of, are they trying to solve a problem, and what is the use case for it? I think if you look at, I look at stablecoins and on a personal level, it's like e-money. It's just a more distributable form of e-money. There is regulation and framework for buying e-money and participating and putting it into your wallet. The question is, what can you do with it? And I think this is where you're seeing PayPal start to sort of expand that I can put my money in my PayPal wallet, but I can also now take it out essentially. In terms of, I think, there's potentially a world where you see multiple stable coins or tokenized deposits that are interchangeable. The trick here is not just it's the regulation and it's the liability framework that sits that everything has a one-to-one value or has an equivalent value that allows them to be interchanged. Because again, there's a real risk, and you see this even with some of the e-wallets, that you create a walled garden and you can't use that money that's trapped in that wallet. And what we're trying to do is create a more open system. We're trying to create this internet of value that we sort of, and the only way to do that is to remove friction, but improve interoperability between the currencies and allow that frictionless flow. And so a stable coin issued by a telecommunications company, that might have a use case and might actually be a viable solution. And it might be interchangeable with the central bank digital currency, hypothetically, or a commercial bank issued stable coin or a tokenized deposit. It's that interoperability and what automatically, to Richard's point, underpins it, and how that is sort of represented in the financial ecosystem. So we don't see it being a winner takes all or only certain participants. I think it's participants that do so within a framework that is clearly defined as to the roles and responsibilities of the issuer and how that is going to be used and what it serves. Otherwise, we're no further forward than we are.
Although it then raises some very interesting questions about the ambit of regulatory power for traditional financial services regulators, and comes back to Richard's point about the appropriate legislative framework being in place to do that. Gentlemen, we're coming very close to our allotted time. Can I offer you the opportunity for a coup de grace before we close? Richard? You're on mute. Richard, you are on mute.
There we go. So, we've talked a lot about what we should do to make, to build trust in crypto. And I think to Anthony's point, I think we can be reflexive also and reflective about the fact that our traditional finance regulatory structure is still inadequate. And so I guess the question I would ask is, if it doesn't work for TradFi, why should we think it will work for crypto? Embracing the principles is great. That's what I've tried to articulate. Getting from those to specifics is really important. We should think about, at the same time, improving our TradFi regs. Two of my friends, Kate Judge and Dan Ari, who are lawyers, would ask 4 questions to evaluate any regulation, and I would repeat them here. First, does it ensure trust in the financial system? Second, is it holistic? Third, is it dynamic or is it static? And, finance is dynamic and we need to evolve with it. And then last, but does it balance benefits and costs? And I think that gets to the heart of some of the things we've been talking about here today. What is the benefit from these innovations? And what is the cost, either in terms of actual financial cost or in terms of the risk that comes along with it? That's what we need to evaluate any proposal for these things for crypto, DeFi, and TradFi.
Thank you. Tom, closing view.
Thanks. I think I'll take Richard's view and maybe give the glass half full version. We don't very often bring a new sector within regulation. This is something that happens, I guess, once a century. It's a long time since anybody had to do it, and we've got an opportunity this time to do it better. Fewer false steps, fewer irrelevant rules. But in order to do it, we've got to get all the countries on the starting blocks and ready to begin. So we've got a lot of work to do just to expand the global regulatory net. And the message for those countries is not to waste any more time, that failure to regulate isn't creating a sort of free bubble for developers to prosper, it's exposing their citizens and everybody else's to risks. But also the way this market is going, you can't build trust or partnerships without regulation underneath them. And those trust and partnerships are what they need in the future.
Thank you. Anthony, can I give you the last words, please?
I think both the fellow panelists have summed it up pretty well. I think trust is ultimately the critical thing here, but also that common framework of those guidelines of what the rules of the road are so that we can work within a framework that is manageable and meaningful, and we can apply the technology and work with the regulators and the innovators to deploy this and to sort of capitalize on this opportunity. I think that's kind of the way I would look at this is I think there's a huge opportunity here, but it needs to be done with care and clear principles so that actually there's no risk or that we don't do any harm. I think that's also the underlying principle that we look at when we talk to our partners with the central banks.
We'll leave this on that then. Do no harm. It'll be our motto henceforward. With that, I would like to thank 4 outstanding panelists for views. That's Professor Richard Berner in Washington, or New York, actually. Daniel Iden, who I believe is in Basel. Tom Nayland, who is in Paris. And Anthony Ralphs, who is in London. I would like to thank our partners, Stellar Development Foundation, Aquanow, and TP ICAP, and please read their contributions in the report itself. And I would like to thank everybody around the world for joining in and participating in this round table. I will reiterate, the report is available now online to download or from a bookseller near you. So thank you to everybody for joining us. Wherever you are in the world, may I wish you a fruitful end of day or a good nap if you are east of London. And thank you for joining us, and we look forward to seeing you again. Thank you, and that closes the show.
Thanks.